Gold has long been viewed as a safe haven asset, meaning its price tends to increase when investors seek stability amid turmoil in stocks, bonds, or currencies. Below, I'll outline some key reasons for gold price hikes, drawing from economic principles and recent trends. For each, I've included when these factors typically trigger rises, with real-world examples. 1. Economic uncertainty or recession fears. Why? During periods of slowing growth, job losses, or financial instability, investors flock to gold to preserve wealth. 3. Geopolitical tensions or conflicts. Why? Wars, trade disputes, or political instability heighten global risk, prompting investors and central banks to buy gold as a neutral, tangible store of value outside any single currency. When? Immediately following escalations, like invasions, sanctions, or major policy announcements that disrupt trade. Example, ongoing conflicts in Ukraine and Gaza, plus U.S. tariff hikes under Trump in April 2025, triggered a rush to gold, pushing it up nearly 30% year over year. Post-9/11 attack saw a 6% single-day jump. 4. Declining U.S. dollar value. Why? Gold is priced in dollars globally, so a weaker dollar makes it cheaper for foreign buyers, e.g., in euros or yuan, boosting demand and prices. It also signals broader currency devaluation risks. When? During dollar index drops, often tied to U.S. trade deficits, policy shifts, or global de-dollarization efforts. Example, the U.S. dollar index fell nearly 8% year-to-date by May 2025, fueling gold's rally despite rising rates. Trump's 2025 tariffs further pressured the dollar. 5. Central bank buying and diversification. Why? Central banks hold gold as a reserve asset to diversify away from volatile currencies, enhancing stability. Increased purchases directly tighten supply and lift prices. When? In response to policy uncertainty or reserve shifts, often announced quarterly. Example, in 2025, banks bought 900 tons amid U.S. policy and geopolitical shifts, with 95% expecting further increases. This propped up prices to $3,700 by year-end forecasts. 6. Falling interest rates or monetary easing. Why? Low rates reduce the opportunity cost of holding non-yielding gold over interest-bearing assets like bonds. Easing policies also signal economic weakness, amplifying safe haven demand. When? After central bank rate cuts, like Fed announcements. Rate cut, first since late 2024, sparked expectations of more easing, driving gold toward $4,200. Similar dynamics boosted it in 2020's near-zero rate era. These factors often interplay. For instance, tariffs in 2025 combined dollar weakness with uncertainty for a compounded effect. While gold's rally, up 50% in 2025, reflects these pressures, prices can be volatile and may ease if stability returns. If you're considering